Hey everyone, welcome back to Stock Talk. Get ready for a really focused analysis today. You're tuning in because, well, you want the insights fast. And that's what we aim to deliver. Today, we are diving deep into Sony Group Corporation's fiscal year 2025 results. This is based on their official report that just came out yesterday, May 14th, 2025.
Yeah, and we've got all the key stuff here, the main financial figures, how the different segments performed, the cash flow situation,
Right.
and importantly, their outlook, including pretty significant change they've announced.
Exactly. So our mission here is pretty straightforward. Pull out the most important takeaways from this report. We want you to really get a handle on Sony's current financial health and, where they might be headed. And hey, if you find this deep dive valuable, please do subscribe, like it, share it, maybe drop a comment. It genuinely helps us keep doing this. Okay, so let's jump in. The first thing you see, the headline number, it seems a bit, well, contradictory. You've got overall sales and financial services revenue down slightly, like 0.5% to 12.96 trillion. But then operating income, that jumps 16.4% to 1.41 trillion.
Yeah, and net income's even stronger, up 17.6% to 1.14 trillion.
So what's really going on beneath that surface level number?
Well, the first thing that really stands out is just the improved profitability. You can see it in the operating income ratio. It went up to 10.9% from 9.3% the year before. That's quite a jump.
Well, okay.
And the divergence you mentioned, the sales versus profit, it becomes much clearer when you sort of set aside the financial services segment for a moment.
Oh, okay.
If you look at the rest of the business, entertainment, tech, et cetera, sales were actually up, and quite robustly 6.9%. And operating income in those areas, it surged by 23.3%.
Wow. Okay, so financial services is really the drag here on the top line number.
Definitely seems to be the main story for that overall revenue figure.
Right. So let's unpack that financial services impact then. The numbers look pretty stark. Revenue down, 47.4%? That's huge. Down to 931.4 billion.
And operating income took a hit too, down almost 25% to 130.5 billion. The report specifically calls out a massive 875.4 billion decrease in something they label other financial services revenue.
That's a really big number. And I guess that leads directly into this major strategic move they've announced.
It does, yeah. They've officially announced a partial spinoff of Sony Financial Group, Inc., SFGI. That's planned for October 1st this year, 2025.
A partial spinoff. So what does that actually mean in practice?
Well, Sony plans to distribute a bit over 80% of SFGI's shares directly to Sony shareholders. They'll hold on to just under 20% themselves. And the key thing is this changes SFGI's accounting status. It won't be a consolidated subsidiary in the same way.
Interesting. So why do it? What's the thinking behind separating out such a large chunk of their financial arm?
The reason they've stated is basically to enhance management focus and capital allocation for both sides. The idea is that the core businesses, entertainment, technology, sensors, can be managed more effectively on their own. And the financial services part, even the remaining bit Sony holds, and the spun-off entity can also have more tailored strategies and resource allocation.
Right, focusing resources where they make the most sense for each distinct business. That makes sense. Okay, so if financial services was the drag, let's look at the stars. Game and network services looks like a real powerhouse this year.
Oh, absolutely. The numbers are impressive. Revenue up 9.4%, hitting 4.67 trillion. And operating income just soared, up 42.9% to 414.8 billion.
Almost 43% jump in operating income. What's driving that massive growth? Is it hardware sales, PS5?
Actually, no. Hardware sales were apparently down a bit. The real engine here, according to the report, is digital. Digital software and add-on content, think game downloads, DLC, microtransactions, that was up over 18%, hitting 2.29 trillion.
Wow.
And network services, PlayStation Plus subscriptions, basically up almost 22% to nearly 670 billion.
So the digital ecosystem is really firing on all cylinders.
Exactly. It shows how effectively they're monetizing that huge player base beyond just the initial console sale. It's that recurring revenue model.
Which is really key for you, the listener, to understand. Sony's gaming success isn't just about selling boxes anymore. It's about keeping players engaged and spending within that network.
Precisely. And we see another strong performer in imaging and sensing solutions, ISS.
Right. The sensors division, how do they do?
Also very strong growth. Revenue up 12.2% to 1.8 zillion. And operating income saw a really healthy jump, up almost 35% to 261.1 billion.
Okay, nearly 35%. What's fueling that? Still smartphones.
Smartphones are definitely a big part of it, especially demand for high-end sensors in premium phones. But the report also highlights growing applications in automotive and industrial sectors. So they're diversifying the use cases.
Interesting. So it's not just about the phone in your pocket, but maybe sensors in cars, factory equipment.
Yeah, exactly. And a key point here is their focus on higher value-added products. It's not just volume. They're selling more sophisticated and therefore more profitable sensors. That's a big driver of the profit increase.
Moving up the value chain. Okay, what about the other segments? Music, for example.
Music had a very solid year. Pretty strong growth across the board, actually. Revenue up almost 14%, operating income up over 18%.
And what's behind that? Streaming still the main driver.
Looks like it. The report mentions streaming, publishing, and visual media all contributing positively. Their catalog continues to perform well in the digital age.
Good to hear. Pictures, though the movie studio seemed a bit more mixed.
Yeah, a bit more of a mixed bag there. Overall revenue was up slightly, just under 1%, but operating income was basically flat.
Any detail on why?
Well, within the segment, motion pictures revenue was actually up quite a bit, but that was offset by a decrease in revenue from television productions. Media networks were sort of stable, so some internal ups and downs.
Okay. And the last big segment, entertainment, technology and services, or ET&S. That's TVs, audio, cameras, mobile.
Right. That one faced a few headwinds. Overall revenue dipped slightly, about 1.8%. Interestingly, though, operating income did manage a small increase, up 1.9%.
So profitability improved slightly even with lower sales. How?
Well, the report mentions struggles in TVs and audio-video, but that was partly offset by some growth in cameras. Mobile communications, though, continues to be a challenging area for them, which isn't entirely surprising given the market.
Right, a very tough market. Okay, so stepping back, it really seems like the core entertainment, gaming, music, pictures to some extent, and the core tech like the sensors are driving the bus right now.
That seems like a fair assessment, yeah. Which makes that financial services spinoff seem even more like a strategic focusing move.
Definitely. Now let's talk cash flow because those numbers looked pretty impressive.
They really did. Operating cash flow saw a huge jump, up 69.1% to $2.32 trillion.
69%. What drove that?
Primarily the higher operating income we've been discussing, plus they mentioned efficient working capital management. Basically, getting cash in faster, managing inventory well.
And that flows through to free cash flow.
Absolutely. Free cash flow is up even more dramatically, over 150%, 151.9% to be exact, reaching on $1.39 trillion.
Wow. That gives them a lot of flexibility.
A ton of flexibility. And you see that reflected in their cash balance, too. Cash and equivalents on the balance sheet increased by over 56%, now standing at $2.98 trillion.
Nearly 3 trillion yen in cash. That's quite a war chest.
It really is. And they're putting some of it to work for shareholders. They mentioned significant dividends and share buybacks in the fiscal year just ended, FY25. And they've already announced another share repurchase program for this current fiscal year, FY26, for up to $250 billion.
Okay, so rewarding shareholders while maintaining that strong cash position. Makes sense. Now, looking ahead to FY26, the current year, what's the initial forecast look like without most of financial services in the mix?
Right. So this is their forecast, excluding the bulk of SFGI. They expect sales to decrease slightly, about 2.9% down to $11.70 trillion. But interestingly, they project operating income to actually increase slightly, 0.3% to $1.28 trillion.
So profitability improving again, even on slightly lower sales.
That's the projection, yes. Though net income is forecast to decrease, about 12.9% down to $930 billion.
Okay. And does this forecast account for things like tariffs, global uncertainty?
It does include some impacts from previously announced U.S. tariff policies, but crucially, it does not yet include any potential impact from that very recent news, May 12th, about potential changes to China tariffs.
Good point. So that just highlights how dynamic things are. That forecast could change based on geopolitics.
Absolutely. It's a snapshot in time, and the landscape is always shifting for a global company like Sony.
Okay, so let's try and pull together some key strategic takeaways from all this. The spinoff seems like the biggest one. A clear signal of focusing on core entertainment and tech.
Definitely. A major strategic pivot. And alongside that, you see this continued successful emphasis on digital content and subscriptions, particularly in gaming and music. That seems central to their profit engine.
Right, and leveraging their tech leadership, especially in image sensors, for broader applications beyond just their own products.
Yes, expanding into automotive, industrial,
Yeah.
diversifying that tech. And overall, it looks like a balanced approach to using their capital investing for growth, returning cash to shareholders, but also keeping that strong financial base.
Now, briefly, risks and opportunities. What did the report highlight?
Well, opportunities include that sharper focus post-spinoff, the strong demand for sensors, digital expansion, maybe even M&A potential, given their cash.
And the risks?
The usual suspects to some extent, tariffs are explicitly mentioned, the execution risk of the spinoff itself, plus intense competition across all their markets, and just general economic uncertainty globally.
Okay, so wrapping this up, the big aha moment seems to be Sony's strong underlying profitability. Even with some revenue headwinds driven by these key segments, and of course, this major strategic shift coming with financial services.
Exactly. Strong core performance, masked slightly by the financial services numbers, and a clear plan to sharpen that focus going forward.
Which leads us to the final thought we want to leave you with today. How will this increased focus on entertainment and technology, combined with that very strong cash position, how will that shape Sony's competitive landscape in the next few years? What kinds of acquisitions or big innovations might they pursue now? Something to think about. Thanks so much for joining us for this deep dive into Sony's FY25 results on Stock Talk.